some folks that are just about as dependable as you can be, and Dr. Glynn Tonsor is one of our foundations. Our Ag Econ department is second to none in the country as far as I'm concerned. The tools they develop, the graduate students that they train, I've been fortunate to be on a few graduate committees over there. It really is good to have them on board. And Glynn, welcome this morning to share with us your beef cattle market outlook.
Thank you, Dale. I don't think it's by accident he said we're on time or a little early, is to remind me to keep it that way. So I will do my best. These slides, and this is always the case, I'll just remind you, are actually already available on the web. So my very last slide, I'm going to show you where they are. You're welcome to write down as many things as you want, but I'm more interested in you connecting with the general theme of our discussion than I am specifics, and you'll have access to the specifics is the point of that. So let's just dive right in here, because I am going to try to keep us on time. As most of you know, I like to start very broad and kind of set the stage from where we are from an overall supply and demand perspective. On a supply side, we continue to add to overall production, but the rate of that increase is really low. And punchline is, I think we're almost done with that. So I personally don't think we're going to expand the breeding herd from here. So we're plateauing, if you like. The specific numbers here, just to give us quick context, 2017, we increased total beef production by almost 4% compared to 2016. In 2018, it was a 2.5% increase. Here in 2019, 1 to maybe 1.25% more than 2018. That's a little unknown on the back end here on weights and so forth. Weights have been lower than some of us thought, so it might be a hair under that. And then out in 2020, maybe 1% more beef production, maybe even flat, okay? So the point of that is those are increases, but they're declining, okay? So the increase in supply story is here, but that is dwindling. What is, I'm gonna argue, more important to monitor is demand. So supply side pressure, downward pressure on prices exists because we have bigger supplies, but we have a pretty good demand story for our beef products, and I'm gonna belabor that on a couple different fronts throughout this talk. And most of you know, economists say you can't say anything about prices unless you look at both supply and demand, is the reason I set it up this way, okay? And I'm gonna use one specific example to make this point. Here's an example, you can look at these numbers later. What I've put up here, just for quick notes, is what the 5 market fed cattle price was, what a Southern Plains 7 to 8 weight yearling price was, and then a 5 to 6 weight Southern Plain calf price was. Annual averages in 17, 18, and I'm gonna call it projected or forecasted, that's why there's an F by it for 2019. And these are year over year changes. And the real simple one, just to drive this point home, is let's look at the 2017 numbers. For all 3 weight classes, prices were either up or flat. One of those numbers up there is 0% because it's a real small increase. Yet, we had 3 and almost 4% more beef produced in 2017. You can only have prices throughout the industry go up when we put more hooves and pounds in the system if demand for your product goes up. That's the only way that happens. You increase supply and you observe prices go up, that can only happen if demand increased, okay? I could belabor that by class and over time, but I don't want to muddy it up there. But I want to really highlight that strong beef demand is always essential, but it's been really essential the last 3 or 4 years as we've continued to put more pounds on the market. Most of you probably know I actually monitor what beef demand is, and we do this different ways, and I'm happy to answer questions about how I do this if you want. There's a lot of purple on these slides, and I won't apologize for that today. I don't apologize when I leave the state, but I definitely won't when we're still here on campus. This looks like a messy chart, but I'm going to give you this text box, which is the real punchline. So since January of 2018, we've had 19 months that I've measured demand. So there's a lag in the data, so I don't know what demand was in August, is the point of that. So I know through July. So there's 7 months in 2019, and then I have all of 2018 in this exercise. 12 of the last 19 months, we've had year-over-year gains in beef demand. Remember the example I gave you about 2017. Cattle prices were higher in 17 across all the weight classes, despite the fact we were producing more beef and more cattle going through the system. The same logic holds here throughout 18 and the first half of 2019. Every cattle price you're seeing would be lower than we witness if it wasn't for good beef demand. Now, that's not to say you're happy with the cattle price. Please don't misunderstand me. Everybody that's a seller wants a higher price. But I think it's really essential to appreciate that the price you're seeing would be lower than what we have if it wasn't for a good demand story. And I know that sounds academic-y because it's an unobservable, but I'm trying to communicate that as the price we have is the net of lots of things, lots of supply and demand factors. And if we lose this strong demand story, we will have lower cattle prices than we have right now. is the real reason that's important to appreciate. So that's a really broad kind of set the stage, if you like, for the whole industry. Now I think it's 4 or 5 slides specific to this complicated development in our state. So I'm sure everybody in the room, unless you sleep under a rock, knows that on August 9th there was a fire outside Garden City, the Holcomb plant Tyson owns and operates. To this day, it's not operating. Okay, we can talk about all that if you want. But what I want to do is just directly tackle that event and talk about what I think occurred. And this, my observation over the last few weeks, is this cuts half the questions down by me directly doing it. But I'm happy to take more questions on it if you like. So that specific plant represents 5 to 6% of the operating capacity in normal times from a fed, steer, and heifer perspective in the U.S., but understates the importance to the state. So I put up here on the slide for everybody, that plant represents roughly 1/4 of normal processing capacity for the state of Kansas. So this is a big deal for the country, but it's an even bigger deal if you operate in this state, if you have a feed yard in Garden City or Dodge City and so forth, right? So this is really important to appreciate. So what actually happened, okay? And most of you probably know this, but I'm gonna tell you the market response wasn't real surprising to me. Now you may not like what happened, but please table that for a second, just hear me out. Is when you lose a facility's ability to process cattle, and then collectively our industry's ability to process cattle changed. Even if we find a way to keep up the total processing volume, we're only gonna do that if we change operations. If we ask some other plants to do more or different. And I'm gonna tell you that to this day, we've asked other plants to do more and different. So we have some cull cow plants that now are operating on steers and heifers. That's a version of doing different. There's a lot of animals that are being shipped further into different locations than they were before. That's an example of doing something different, okay? Well, nobody does something different for free in general, right? So there's gonna be a margin benefit that comes with that. And I could stop the story right there, and that explains a lot of what's going on. But let's go further. If you have this shock that collectively is making it more challenging to process cattle, that's going to, in econ speak, decrease the derived demand for fed cattle. All else equal, if I'm a plant, the industry of plants if you like, my interest in fed cattle is a little bit lower the day after this fire than it was before. Because I've got to do something different, or I've got to pay a certain number of people an extra shift of overtime than I did before, and all those kind of things. That will depress fed cattle prices. Fast forward, did we observe that? Yes, we observed that. So the first market week after the event, the first 2 operating days, the CME, both futures for live cattle and feeders, were limit down, which is the most they can drop for 2 particular days, okay? And cash markets more or less follow that week. But that's not the end of this story. So that's the cattle price piece of it. What about going the other direction? So let's talk about the beef market now instead of cattle prices. You have the wholesale beef market, which is boxed beef, choice cutout, that's quoted and most of you probably are aware of. I tried to set the stage for you telling you that processing costs are higher than they were the day before the fire. We're either hauling animals different direction, or we're paying people to work longer hours or second shift on Saturday, those kind of things, okay? Some of that's gonna get passed on upstream. That's part of the story here. That occurred. So we would expect that wholesale beef prices would go up and fed cattle prices would go down after an event like this. And that's exactly what occurred. Specifically, we had the 2 largest daily changes in the cutout price. I believe it was Tuesday and Wednesday, but it was the week following the market event, which was a strong reaction to what we're talking about. And if anything, there's been more talk about the boxed beef market change than there was the cattle market change, comparatively speaking, after the event. And this slide, I think, is central to that and is not getting recognized. So again, it's a messy slide, but that's okay. I'm gonna tell you the story here. What I have here is USDA's estimated volume of cold storage stocks, so how much beef we have in the freezer, so to speak, that comes out every month. We monitor this. There's a cattle on feed report most of you are aware of. Roughly at the same time every month, we also get a cold storage report that pegs how much meat is kind of setting in the supply chain, if you like. What's most important here is the month before this fire, we had pretty low cold storage stocks, okay? I could belabor that more than that, but that's the punchline. So we entered the event with fairly low cold storage stocks. That's actually a good thing in many ways for the industry, because that's another comfort that we were current. We didn't have beef stacking up in the system, right? If cold storage stocks were really big, I'd be worried that's putting downward pressure on cattle prices. That wasn't what was going on. But specific to this response to the event, if we have a low number of pounds in the freezer and I'm a buyer of beef, so think I'm retailer X, all of a sudden I get real concerned because there wasn't much in the pipeline, and now there's a lot of uncertainty about how long that plant's going to be down, how much beef was lost in the fire, and all that kind of stuff. Okay? So the safety blanket from a buyer's perspective disappeared, and there was a lot of uncertainty. So I'm telling you, those buyers rationally started bidding a lot for beef in response to this because there wasn't a lot sitting in storage, and there was a lot of uncertainty, particularly the first week or 10 days after the event, how long the plant's going to be down, how much beef was lost, and like that. Okay? So to me, it should not be surprising that we had a large increase in cutout prices and a notable decline in fed cattle prices. That's a long way of telling you why I think that is not surprising, and you're welcome to disagree with me, but I think it's important to at least have that thought exercise as you go through the process. Okay? So now, having covered that topic, at least for now, let's transition and go from cow-calf sector all the way to the end consumer. I'm going to end with some trade points. First and foremost, where are we at with the actual herd cycle? I made the comment, I think we're probably done expanding. This slide is kind of along those lines. The cattle cycle that has an 8 to 12 year horizon, we talk about a lot. The solid blue line, which is right here, is the quote-unquote current cycle. You can see it's been fairly flat for 3 years. Sitting where I am right now, I anticipate that to sort of be flat and slowly decline over the next couple of years. Now, we could have an economic shock in 12 hours, I'm going to change my story. But as of right now, I don't see a reason to squeeze the industry smaller, because we're not talking massive losses for cow-calf producers, because that's what it would take to pull down herd size, or Mother Nature, if we had a drought in Texas again or something like that, would quickly change this. But short of those two, I think we have a plateauing of the herd, a continuation of what we had, not a lot of interest in expanding and not a real interest in shrinking the herd. That's what I mean by plateauing. Where are we at with prices from a cow-calf perspective? This is one of several slides I get from LMIC, Livestock Marketing Information Center. They maintain these charts. I bring them to you, and I'll tell you how this one's set up, and they're all kind of set up the same way. The red line is the old 5-year average, 2013 through 2017, so it gives you some, let's call it recent historical context. The dotted line is 2018, and then the solid blue line is 2019 to date. There's a purple text box up here, which is a rough area for me projecting what a calf price is going to be in October. And at the top right, I've got another text box I added that has a specific number. So this afternoon, you're going to hear from Brett Crosby, and I'm not going to take his thunder. He's going to spend a lot of time talking about a resource called beefbasis.com. Several of you have heard, they're not commercials, but I'm regularly raising awareness of it, and I'm a user of it. So this is a specific example of using it. So this morning, when I was updating these slides, I got on my computer, went to the website, and I came up with a projected price for Salina for a 5.5 weight for the middle of October. That's what I did. And doing that exercise, I come up with a projected price of 156. That's the number that's at the top right. What that is what was the CME's close last night, feeder cattle contracts, with basis projections. So Kevin Duvetter, most of you know, and myself and others work with Brett and his team to monitor this tool. So the way the tool works is you take the futures close with historic basis relationships to come up with projected cash price. 156 is my best guess for a sale price for a calf, middle of October, Salina, okay? What does that mean for margins? Well, that's just revenue, right? So we gotta have some insight on the cost side. This is a slide that goes back to, I believe it's 1990, maintained by USDA, and it's an estimate of the cash cost to run a cow in this country. The purple line over time is just a simple linear trend. I always include it to give you some general long-run insight. On average, we're increasing the cost to run a cow by about $20 every year. That's what the interpretation of the regression line is up there. The final number you'll see is for the year 2019. USDA estimates it'll take $859 to run a cow. That's the cash cost now, not total cost. So you've got some unpaid labor and so forth that would be above that for total cost. $859 to cover your cash cost. That implies a break even, if you sell a 5.5 weight calf, of 156. So anybody that's still awake out there, I just told you projected sale price 156, and just by chance comes to exactly a 156 break even. So projected break even to covering your cash cost is the story today for somebody that sells a calf in the middle of October in Salina, okay? And that's not too indifferent than this slide. So this is another resource from LMIC, and every couple months they update their own projected returns. And this is a projection on the return over cash cost. Again, goes back to 1990 for a quote-unquote typical Southern Plains cow-calf operation. The bar for 2019 that's up there is a plus 21. So when they did this, and it was as of the 4th of July, they were projecting a $21 per cow positive return. The October feeder cattle contract has moved a fair amount since July 5th, but has actually rallied some in the last few days. So we're not far off from where it was when they did this. 3 weeks ago, I was pulling down this projection because the board was way below where it is now, but it's come back to where if you redo what they do in this exercise, they're going to be similar to a plus 10 or plus $20 positive margin. Break even projected for cow-calf producers, and I'm counting $10 positive as break even. That's well within the rounding error of these exercises. So now let's go to the next stage in this production chain, and let's just take the possibility of backgrounding. This is a chart from Cattle Facts. I'm not giving a commercial for Cattle Facts. I just like this visual. Most of us know we do a lot of different things with calves to get them to a final weight. As a side note, we don't sell 1,300 pounders anymore. This should be updated to 1,400, but it still works for my purposes. And I want to talk about the backgrounding enterprise. So what if I take that 5.5 weight from Salina in the middle of October, and I plan to sell it in January, roughly 100 days later? I'm including this because it's an example margin exercise in the feeder cattle complex that everybody in this room has some interest in, and you can change the dates and the location and weights for your own. But specifically, if I take that middle of October 5.5 weight, I plan to sell it at 200 pounds more, so I anticipate it weighs 7.5 in the middle of January. What's up here is a projected sale price in that story of 136. And remember, I told you earlier, I'm saying you're going to have to pay 156 for it here in about 3 weeks. That implies a value of gain of $80 per hundredweight, which is $160 per head because you're putting 200 pounds on in this story. You would need to compare that to your own cost. What do you think it's going to cost you to put that on? And for the last 3 or 4 months, I've included and assess your stomach for volatility because there's a lot of moving parts in the industry, uncertainty on the policy front and so forth. So you need to assess your cost and then your tolerance for risk. You need to do both to see if this is of interest to you. $80 cost of gain would be on the high end if I was to push a pencil for somebody in the room. But for some of you, that might be accurate. 60, 65 might be closer for a lot of folks if you push the pencil at home, particularly just cash cost. So there might be a positive margin in this, but then you need to assess your tolerance. Is that positive margin big enough to absorb the market risk of selling in January? That's how you use this resource. Now I'm going to highlight 2 other, one's a decision aid and one is just an awareness of a USDA program. Most of you probably know there's Livestock Revenue Protection, or LRP, which is an insurance product for the feeder cattle complex. More generally, there's several ways to protect prices if you're a feeder cattle seller. You could take a position on the futures market. You could take a position in the options market. You could do forward contracting. There's a lot of different things. This is a mini commercial and a raise awareness of a tool on our Ag Manager website. Again, Kevin Duvetter built it first, and I just kind of tweak it and keep it working and update the defaults over time. It's called the KSU Feeder Cattle Risk Management Tool. Us academics are real good at fancy names, as you can tell. But that's exactly what it is. It helps you compare how these price risk management tools will work. I'm highlighting this because A, it's there, please use it if it's helpful. But secondly, the LRP product changed on July 1st. The federal subsidy on those premiums went up. So it's not free, but the government's paying a higher share of the premium than it was before July 1st. And they actually increased the total number of head you can cover. So I believe it's 6,000 head is the cap that you could cover in 1 year on feeder cattle, and it was lower than that before. So I'm not here selling everybody to go sign up for LRP. Please don't take it that way. But if you previously used it and it worked, it probably works even better today because the premium's higher. Or if you haven't thought about it before, it might be worth looking at, is the point of that. The second thing I want to highlight, because this past winter this was relevant, is the Livestock Indemnity program. So if you lose feeder cattle, whether they are young calves or later on, and it's due to adverse weather or disease or some other things that are quote unquote beyond your control, there is a program that's offered by the Farm Service Agency that helps you get some indemnity for that. I'm just raising awareness to it. There's a link here. Come to the website, you can get it. But most importantly, and the reason I'm doing this, is in order to actually get compensated, you have to document the loss within 30 days of the event. So I'm going to give you the example. Let's say some of you have cows at home and we have a really bad winter and you lose more than normal because they hit the ground when it's really cold. So your death loss of calves is higher than normal. Documenting that within 30 days of that event is necessary for you to be eligible for these funds. You can take several months to work with FSA and actually get paid and so forth, but you've got to document it within 30 days. So having a vet observe it and write it down or get other kind of proof, get some evidence in your pocket is essential. So I'm planting the seed in your head. I'm not wishing a bad winter on anybody. Please don't take it that way. But if it happens, and it happened this past year for some, this is important to be aware of. So now let's keep walking through. Let's go to feedlots. This is a real fancy statement. 2019 remains rough. All I mean by that is cash margins are quite negative for the typical feedlot operation. Most of you probably know I maintain what I describe as a barometer of cash returns for the feedlot industry. I actually take another resource from the Animal Science and Industries Department. It's the Focus on Feedlot survey. Justin Wagner and others are central to that. So feed yards around the state complete a monthly survey, and I might call it production data. So in weights, out weights, death loss, that kind of stuff comes from that. And I marry it up with market data, both what I think they've paid and what I think they're going to have to pay in the future, to come up with net return information. That's what this is about. And I'm going to talk about two specific closeout months to drive home the dynamics on margins in the feedlot industry. What's up here is for the month of September, as of September 13th, I was projecting a loss of $339 per steer. Quite negative. That presumes you didn't hedge anything when you placed the animal, presumes you bought corn as you needed it, and presumes you take the prevailing cash price in September. That's what's embedded in this assumption, okay? The sublines as you move to your right is I'm presuming that the Fed futures will be on average $98 for the month of September, and basis is almost zero, so therefore the cash price is 98 and change, that your cost of gain is crowding $90, and that you paid $143 for the incoming animal, 5 to 7 months earlier. That's basically what the assumptions are. You change those, of course, you're going to change away from minus 339. What I really want to drive home is how that story changes if you look out to animals that might be coming out in March, okay? So the projection for March, again, these are projections because March is a ways out, is a loss of $29, $30. So why is that $300 different is the punchline of this story. It's mainly sales price. So if you look in there, the Fed futures is 119 for that particular month, be pulling off the April contract, with a basis of $4. So Fed futures is 115, basis 4, cash price 119. That's a much higher sales price than I'm telling you is going to happen most likely here in September. That's the main difference in the margins here. But there's also a lower purchase price. So the feeder cattle, when they go in, coming out on March, are $7 cheaper per hundredweight, okay? Feedlot margins do this all the time, is when they're negative, we put pressure back on feeder cattle prices. That's what's occurring here. The cost of gain actually is projected to go up a little bit. 97 is feeling quite high here, but that's what's baked into here in my estimate. So if you can get down to 85, your margins are going to be positive that month, is the point of that. So there's break-even cost of gain off to the side. But what I'm really, really highlighting is a big change is forecasted in the market in fed cattle prices to take us from a really rough ending of 2019 margins to break even or maybe positive, let's say the April, May, June period in 2020. LMIC puts out these quarterly projections as well, and they last did these at the end of July. They're due for an update this week. What's up here is quarterly, and then the yellow bars are the annual averages. This is the production forecast, so commercial slaughter and then dressed weights and then commercial beef production. I've already given you the punchline of this. My very first slide told us the year-over-year changes. So additional beef production, but the rate of that is going down, and all the way out to 2020, maybe 1% more beef being produced. I could probably even build an argument that's getting closer to zero. So we're towards the end of it being flat to a small increase in 2020. Here's the parallel price information, and let's just take fed cattle first. The number that's up here for the fourth quarter is a range of 114 to 117 for fed cattle prices, but I'm going to really highlight this. That was when this exercise was done on July 28th. Recognize fed cattle prices have come down since July 28th. So to make use of this forecast, we need to adjust it, and basically there's been a $6 or $7 decline, depending on which futures contract I would use, since then. So the way I'm going to do it to hold your hand here is to addend that forecast. I would make that a 107 to 110 range for the fourth quarter, which is starting to line up with what the board is, by the way, okay? That's part of what's in those very negative margins that I just shared with you earlier when I do my feedlot profitability exercise. Now let's do this for 5 to 6 weights, for example. The fourth quarter numbers up there are for 156 to 161. Sales price for Southern Plains 5 to 6 weights. Again, feeder cattle are yearlings are about $4 off since this was done. Calves are going to be off by more than $4, so we need to pull those down. You real quickly get to the low 150s, which are in line with what I shared earlier from the beef basis tool. Okay. Ongoing negative losses the rest of the year for feedlots, probably a break even for cow-calf producers. That's wrapping a bow around all that. So now let's talk trade for a second. I made a comment to start off that demand is essential. Please recognize when I say that, it's demand for all products coming off a steer, no matter if it's consumed in the U.S. or abroad. It's a culmination of all that that gives us total demand for ultimately cattle, but first and foremost, U.S. beef. So I maintain a beef export demand index that is separate from a domestic beef demand index. You can have growth on the foreign front and not have growth at home and vice versa. That's very important to understand. The products we export are very different than the ones we consume here. All that kind of stuff shows up. But the punchline here would be in July, again, there's a lag in the data I have available. July of 2019, our beef exports were 128% higher than they would have been if demand had not improved from the base period. And in this exercise, the base period I started, it was January of 2010. Stated differently, we'd be exporting a lot less had export demand not grown since January of 2010. I might go further. If we weren't exporting that much more, those fed cattle prices I just told you about would be even lower, okay? And we would have sent a signal to shrink the herd earlier and harder too. All that would be part of the story. So here's an example of appreciating the importance of not just demand, but in this example, foreign demand for U.S. beef. Even more narrowly, 17 of the 19 months since January of 18, we've had year-over-year increases in our export demand. That's really good. And in 2018, it was a really good year. And frankly, I'm pleasantly surprised in 2019, we've kind of kept it up despite some of the headwinds we've had on the policy front and the strong U.S. dollar and all the other stuff that comes into this. Even despite that, we have a really good export demand story. I hope it continues. I'm just not convinced it can go on forever, is why I'm highlighting it, is we need to appreciate its essential role on our prices. I'm going to skip that and jump to here. My last two kind of plant the seed for questions. And by the way, if I don't like the question, I'm going to make Dawn, who speaks after me, answer it. I have that pleasure of doing that today. I'm going to plant the fodder for two big topics that come up a lot. Well, one is, what is the role of African swine fever in everything I'm talking about today? Most of you probably know that is a disease in the swine industry. There's a lot of effort here in the U.S. and Canada to keep it out of North America. But to date, this disease continues to spread across Asia and other parts of the world, but I'm just going to talk about Asia for a second. And there's ongoing uncertainty on when we might actually have a price bump on U.S. livestock as a result of that. I include up here a picture. This is actually the CME live hog contract, just to remind us of some of the volatility that's been in that contract. I believe it's the October one that I put up here. But we went from $60 to crowd $90 on that contract, in large part out of, I'm going to call it optimism, that we were going to export more pork in response to ASF. There's other parts of that story, but that was a big part of that rally. And we've given a lot of that up since then, and it's not all because of ASF. But on balance, we aren't exporting as much yet as some were hoping we would by now, sitting here in September, in response to this. I'm not telling you we're going to export a bunch tomorrow. Please don't take my comment that way. But there is a big protein gap in Asia in response to ASF. And that's this kind of perpetual uncertainty about when will the U.S. industry benefit from it. We keep talking about it. I think we have to keep our mind on it because it is on the list of things that is potentially bullish over the next 6 to 24 months that might help support cattle prices, hog prices, and the like in this industry compared to what they would be otherwise. The other one is before August 9th, which again was the date of the Holcomb Fire. Before then, by far, the most frequently asked thing in my plate, what I was getting calls on is, what are these alternative proteins? How fast are they going to make traditional beef disappear? Please explain, talk to me about this. Get lots of questions in that space. I'm happy to talk to you about that as well. The reason I bring it up is that topic's not going away. There is massive investment in new and competing protein products, and I'm happy to visit with you about it. I don't think that's going to stop. If you want my 30-second summary, I'm a big believer that global demand for protein is strong and over time is going to remain strong. There's a lot of things that make people want to have protein and different kinds of protein than they used to have in their diet. And frankly, I think there's room for traditional protein, such as beef that comes from a live animal and other conventional proteins, and some new ones. I think there's an economic pull for some of these products is the point. So I think we got to get used to some new competing alternative proteins being in the discussion. Now, the second layer to this is what should or can they be called? What can they be labeled? You got those little sub-points of that story, and I'm happy to talk about that, and that's where it gets complicated and political real quick. But I think it's important to appreciate there's a big economic pull for why these products are even being built. And that is because there's faith in a protein demand that will support new products. If you agree with that, then you need to recognize we're going to have these new products in our discussion no matter how they're labeled, basically. Okay? My wrap up, supply side factors are well established. We pulled the trigger on expansion. I'm trying to tell you I think we're done with that, probably plateauing. So the determination of price is less about if we're going to expand the herd or not. Mother Nature aside for a second, I think we've plateaued the herd. Demand remains essential. Hopefully I convinced you of all that. In bold down here at the bottom, and actually not in bold, when the next U.S. recession is essential because domestic beef demand tends to take a hit when we have a recession. I'm happy to say we don't have one yet, but there's ongoing concerns on that front, and us as cattle industry need to be aware of that. The beef industry is most sensitive to a recession, is why that's even more important. And then secondly, more generally, how long will the consumer favorability for a high protein diet persist? I tend to be pretty optimistic on that, but I'm one man, one opinion, and we need to be aware of if that was to weaken, that would also be a problem on the demand front. Okay? This is my last slide. For those of you who haven't been there, agmanager.info is the extension website for our Ag Econ department. This morning, these have already been posted, so there's a PDF of these slides. Please go get them. Over time, I give versions of this talk. Hopefully you don't think the tone of my story changes, but some of the charts get updated and so forth, so making use of that over time is what I encourage you to do. So Dale, with whatever time we have, I'll take some questions. I think I scared them off. Yeah. So Levi is a former student for the department, so he's trying to get geeky on me to take his shots while he can. But I'll repeat the question or summarize it, is what do I think is going to be the sequence of events if and when these products continue to roll out? Will they displace conventional products? And then you also added to the question, do I think it's going to change the relevant role of exports? Okay. The answers are yes and yes. So I'm going to take them in reverse order. I think I can build an argument that particularly the products that are placed as alternative hamburger substitutes, which a lot of the Impossible Burger type products are positioned that way, is some of the immediate aftermath of that'll be, we won't necessarily have to import as much for lean beef production to produce hamburgers as we did before. That's code for this is a new way to produce a hamburger substitute compared to what we did 5 years ago. Okay? So on the trade front, I think it will change the import story, is to think through. The second will be, let's think through who might be buying these products, and then therefore what they're substituting out of. So if you are a U.S. resident who becomes a regular consumer of these new products, to say you're that subset, if you previously were a major consumer of conventional meat, so if you weren't a vegetarian, a vegan, or a flexitarian, but you're a mainstream consumer, then there is a substitution, because there's only 21 meals in the week, right, so to speak. If you were a vegan or vegetarian, there was no substitution because you weren't consuming traditional to start with, right? So the balance of those two populations is really important to appreciate. On balance, I think if these products continue to get better, get marketed, and get their costs down, which I expect all three to happen over time, that we will have in total some displacement. Some consumers in this country will respond to claims about environmental footprint and animal welfare impacts and those things. And I'm not here to tell you those are accurate claims. I'm just telling you those are strong marketing claims that will work to some extent. You understand the difference? If that happens, I actually think we could increase U.S. beef exports, because I'm not convinced other parts of the world are as responsive to environmental and animal welfare claims as some targeted U.S. consumers are. Are you following me? So I think you will change the market for imports, and I actually think I can make an argument this growth will increase our exports, and we collectively, specifically the beef industry, we might speed up our dependence on exports because the marketing claims for some of these products don't resonate with certain consumers in other countries that import the same as they do certain pockets of the U.S. population. That's my best guess based upon what's in front of me right now. Did I answer it? Okay. Yep. Sure. Yeah. So that question's from Brett Crosby, who's going to give you the full talk later on beef basis. And what he doesn't know is it's very dangerous to ask a speaker a question when he gets a shot at you later when you're up later. So keep that in mind in a few hours. The question was about the live cattle contract, the ability to converge, how it is settled, what's the interaction of low or non-existent at times negotiated activity, what's the net of all that, in so to speak. How do I want to answer this? That discussion isn't necessarily new. For several years, there's been discussions about should we change how the contract is settled? Should we change different delivery locations and go to different settlement procedures and the like? Some of the political consternation has changed over time, but the core question, I would argue, isn't any different than it was 3 or 4 years ago. The thinness in the cash negotiated market has changed a lot over time. Kansas actually negotiates a little bit more now than it did 2 or 3 years ago, but still the vast minority of our production, okay? The reason for those in the room that were worried about that is if we have a small share, and I'll pick on Texas to really make my point, if a small share of the cattle are negotiated, do we really know what that day's value of animals were in that market? That's the debate, and that's a fair question. It's part of my job to kind of tell you why we got to that point and why these are intersected. Most studies will say that mandatory price reporting, or more narrowly LMR, livestock mandatory reporting is the code for USDA, that started in 2001, has indirectly and it wasn't the intent, but it's happened, has made that issue worse. We negotiate less than we would have before because we now have faith in what is reported, and therefore I have faith in formulating off a report from yesterday or last week. Do you understand my point? So my humble opinion is the issue about thin negotiated trade has gotten worse in part because we've changed how we report. But on balance, that might be good because we might be more efficient in producing fed cattle because we're not spending as much time in identifying the value of cattle as we did before. That's a net trade-off, okay? Not everybody agrees with that, and particularly those that are trying to offset a position on the CME board is where the questions come about changing the settlement procedures. I'm not going to sit here and take a stand on what's the right way to change settlement. That's an ongoing discussion. CME and different cattle associations keep bringing it up. There's pros and cons to every potential solution I've seen. So I'm not going to take a stand on one of them being better.
Just a quick follow-up, but do you see a change in the contract coming to help facilitate?
So Brett asked, do I see a change in the contract coming in response to this to maybe help facilitate? You're asking me to predict if CME is going to change something now. Not in the real near future. I think you have a hard argument. Think through how CME works. Is the volume on a particular contract is important to them. If you can run the volume up so there's more transactions, they can make more, right? So they're going to make more on corn. December corn contract has a much higher trading volume than any live cattle contract's going to, right? They're going to be sensitive to these things, but unless you convince them that it's going to notably increase, there's not a revenue trigger for them to make a change unless you're going to notably change the volume of transactions. So if you think the industry is going to use contracts way more by making a change, maybe you'll have a sympathetic ear. I think that's a hard argument. So the question is, what will happen when the plant comes back up, right? And particularly you're honing in on live cattle prices, the dynamics of that. First and foremost, Tyson to this day has announced they're going to reopen it. So that's a presumption in the question. So I'm going to presume that as well until told otherwise. Secondly, in stock calls, so Tyson's a publicly traded company, so you have record by CEOs and so forth. There's discussion about the plant coming back up in January. I'm not sitting here promising you that, but that's our current best guess of when it'll come back up in operation. So that's important on the duration we're operating without it, is the reason I'm giving that to you. I do anticipate, all else equal, once that plant is coming back up and it's in full operation, so not the first day, but once they get the bugs worked out and we're fully using it, that we will actually, that itself is supportive of fed cattle price compared to before. Because it's the reverse of what I said earlier, right? You're going back to the industry's able to process cattle cheaper and better and more conveniently than we're able to from August 10th through Christmas, okay? So that is supportive. But I want to make sure I'm very clear on this. I don't think there's a panacea that's going to add $10 of value to fed cattle there. I think it's supportive, but it's not a game changer on the margins I'm talking about. There's a lot of other things that are part of the story that is concerning on fed cattle prices, but that is just one of them. I will remind people that the week of the Holcomb event was one of the most volatile in the stock market. So a homework assignment, go pull up what the early August looked like on the S&P 500. We had large volatility in the stock market. Why am I telling you that? Lots of macroeconomic uncertainty was going on, and we're not past that. And that is part of what's going on in the cattle price complex, even without the Holcomb event. And I don't anticipate that's going to disappear just because the plant comes back up. Just going to highlight that for you. So, yes, it's supportive, but it's not going to add 10% to fed cattle prices. So it's not a game changer in that context.